All right. Well, Debbie, thanks for being here. Uh, Appreciate your time.
You're welcome. It's my pleasure.
Okay. So, can you please introduce yourself and your role in facilitating 1031 exchanges?
Absolutely. Well, for me personally, I've been employed with Exchange Resources for
Hmm.
25 years.
Wow.
And yeah, it's been a wonderful ride. And the company, I came in about 6 months after the company opened. So we're in our 25th year anniversary this
Okay.
year.
All right. Great.
So,
Great. Great.
and my role with the company is I basically educate, consult, and educate. I help people understand how to utilize the 1031. And then my company provides the service.
Okay. No, very, very good. Now, people sometimes have an idea of what a 1031 exchange is. For someone that is an investor and doesn't really know much about it, can you please enlighten us as to what is a 1031 exchange?
1031 exchange is a valuable tool. It allows an investor to defer their capital gains on the sale of investment property. So 1031 is a section of the tax code.
Mhm.
And, and by utilizing this tax code successfully, the taxpayer then, or the person that's selling their investment property, if they utilize this code properly, they can take all the proceeds from their sale and buy more investment property instead of buying investment property with what's left over after paying taxes.
Okay, so let's just unpack that. So if I'm an investor, if I have rental property, let's just say I bought it many years ago for $200,000. Now it's worth a million, right? It's worth a million. That
Mhm.
that property I bought for 200,000 worth a million. So I have a capital gain, right? About $750,000 or
Mhm.
more of capital gain. I should be taxed on that, right?
Exactly.
Okay, and I should be taxed on that at the rate. Let's just say I've owned it for like 20 years. The rate on that is that 27% around there?
It's approximately 15% federal. It could go to 20, depending on your income. If your income's over 400K, state then is added to that. California, it's approximately 12.3.
Okay. So 12,
And then
12.3 plus you said about 14.5,
15%.
15% plus 12, is about 27 or 28%, right? Is the
Exactly.
what
And
is
that's
what
the capital gains tax.
that's capital
So
gains tax.
federal. There's also something called recapturing the depreciation. So the total depreciation taken on the property for the life of it being an investment property gets tallied up, and the taxpayer would need to pay back 25% of that total.
Okay. So you're talking about every year when I own my investment property, when I do my taxes, I depreciate the structure, right?
Yes.
And so all those years, let's say I owned it for 20, 30 years, all those years where I've been depreciating, not paying tax on this, now that I sell the property, I have to pay all that back.
You pay 25% of that total.
Okay. All right. So then the way, the way that I would not pay the taxes is if I do what?
You utilize the 1031 exchange tax shelter, but just know this, that it's not that the 1031 does not get you out of paying the taxes. It just defers the taxable event till
Mhm.
later, till a time that you sell and you do not do an exchange.
I see. But I have to buy another property, right, to defer the
Yes,
taxes, and
yes,
those are deferred. Okay.
yes,
Now, are there any misconceptions that that people sometimes have about a 1031 exchange?
absolutely. One misconception is that it's a loophole around the tax shelter, around the taxes, and people are getting away with something. That's not the case. It's, it's a part of the tax code. And again, it's a deferral of the taxes, not an escape. The next
Okay.
loophole, the next loophole that we're going to talk about in a few minutes is there's language in the code that makes it a little confusing. Like they talk about that it needs to be like kind, an exchange needs to be like kind. And I think we're going to talk about this a little bit later, but the point is like kind has nothing to do with what type of property you're selling, like an apartment complex, commercial, single family rental has nothing to do with that, but everything to do with how it's used. And I think that's one of the biggest misconceptions. People call and like, I have I have this apartment complex and I want to buy several single family residents, but I probably can't do this because it's not like kind.
Okay.
Actually, it is.
Okay. So what I'm hearing is if I have, let's just say 2 to 4 units and I want to do a 1031 exchange, I'll sell it. Let's just say I bought it for 200,000. It's many years later, I'm going to sell it for 1 million. Now I'm going to buy something of like kind, right? And what are my options then if I'm going to buy something of like kind?
You could buy anything that's real estate anywhere in the United States, as long as that property is used as a rental or for a productive use of a trade or a business.
Okay. So I can buy any property in the country and it counts as like kind. So I can buy
Exactly.
single family houses, I can buy condo, I can buy units, I can buy commercial, I can buy residential, 5 units or more, as long as it's a rental property.
Exactly.
Okay. All right. And so besides the you're deferring your taxes. You're deferring your taxes. This is the question I have. Besides the tax deferral, are there any other benefits to doing this or reasons for?
People use the 1031 as a strategy for their heirs for inheriting their properties in the future. And that can be a beautiful benefit because whoever their beneficiary or their heirs may be, if if the properties have been set up like in a trust and it's set up properly that way, then those heirs will receive that property with what IRS refers to as a stepped up in basis. So the past taxable event will die with the person, with whoever owned that property. And the valuation of that property will be determined at the time of death. So say your example that you used a little earlier that they bought for 200, originally bought for 200, now it's 1 million. Now let's say that property is worth 3 million. That could be a huge taxable event, but if something happens and the heirs inherited that property and they value it at 3 million at the time of death, and they sell it for that value, they have no gain, they have no taxes.
Ah,
They have to
okay.
pay.
I
So
did not know that.
it's
That's a
huge. So people
yeah.
use it as a tool for their heirs for inheritance purposes. And it
Okay.
can be a beautiful gift.
Okay. So let me just make sure I restate that just to make sure it's clear for our audience. If I have a property that I buy for 200,000, I sell it for 1 million. I reinvest those proceeds, $750,000 proceeds into more property. That new property that I buy for over 1 million um, appreciates over time. You're saying to 3 million. And I buy multiple apartment complexes, 3 million out of state. Now, when I die, my heirs have a property. If they choose to sell it, you're saying they're not going to pay the capital gains that I deferred?
Yes, because they get a valuation at death.
Okay.
And if that value, whatever that valuation is, in this example, we'll say it's 3 million, they sell it for that same valuation, that heir has no gain because they're
Hmm.
selling it for what they inherited for.
Okay.
And then if they hold on to it and say later on goes to 3.5 million, then they only pay taxes on that 500,000
I see.
from the time of inheriting it.
I see. I see. Okay. No, that's something I did not know. Now, my other question here is what types of properties, but you said any investment property, anything that's used as a rental, right?
Yeah, so the type of properties that qualify for 1031 exchange, believe it or not, raw land qualifies. So you can sell raw land and buy anything that's real estate as long as it's used for investment purposes, like we
I see.
defined
Okay.
earlier. So
Okay.
anything again that's real estate, they can sell that, purchase something else, and it qualifies. What
Okay.
disqualifies it is personal use. This is, you can't sell investment property to buy something for a primary residence. That would not qualify.
I see. So you're saying if I bought it, let's say I did that scenario, let's say I bought a house and let's just say I want to move into it. I 1031 into the home. Um, now I move into it. What happens there?
Okay, so that if you move into it right away, it would disqualify that exchange. So it could cause you some trouble. You'd probably most likely get audited
Hmm.
and you would have to pay penalties and interest.
I
So
see.
IRS does allow a conversion where
Hmm.
later on you can move into the property. But what's important to know is you must rent it for minimum 2 years before you make any conversion. And then after that, you have to live there for a total of 3 more years. So it's a total of 5 years to qualify for a prorated part of the primary residence exclusion.
I see. I see. Okay. Now, it's not an easy it sounds like very easy, but there are some timelines and some
Right.
in the law that, and so can you walk us through, how a 1031 exchange works?
I
Yep.
absolutely can. So what'll happen is in the beginning, when the property is being listed, it's really important at that time for the agent representing that client to find out what the client's intentions are. If they know this property was a rental, ask the client, what are you planning to do? Are you planning to sell this to buy more investment property? If that's the case, then the 1031 would probably be the tool they need. So once we establish that, get it established early, because when they actually accept an offer, go into contract, then that is the time when escrow is open, but the exchange would need to be open. So,
Okay.
so an exchange needs to be open with a qualified intermediary, like a company that we are. But bottom line is that window of opportunity to have an exchange is in that escrow period. If escrow closes and there's not an exchange set up, they lost their opportunity to have one. So it's got to be set up in that window.
Okay.
Then,
So you said step one is to identify, before you list the property, identify what your goal is. Are you going to cash out or are you going to buy another investment property?
yes,
Let's just say I'm going to buy another investment property, do a 1031 exchange.
right,
So when I accept an offer, I need to um, hire an exchange company like you
yes.
to put the proceeds into, so that when it closes, the company, your company, has my proceeds, right?
Right. And that's why it's important to start this early with the listing process, because it's important to get all their questions answered, figure out who the qualified intermediary will be, get all that figured out, hopefully before you get into contract,
Mhm.
before an offer is accepted, because that way we're not wasting valuable time answering questions that could be addressed over here. So we
Okay.
want the taxpayer, the client to understand the process and not be in the dark.
Okay. So their proceeds will be in the intermediary's possession, right?
Yes,
Like the escrow account. And if they, you said, if they do not identify the intermediary and pass the funds over there for the escrow, then they are going to get taxed. You can't go backwards.
right. They lost their window of opportunity. There was no exchange set up. The proceeds were released to the taxpayer. It's too late to unravel that. So
Hmm.
they need to get that all determined before in that escrow process.
In the escrow process. Okay. So let's just say we close escrow. We close escrow. The next step is, or what are the next steps and timelines?
So the next step is that the day after or the day of escrow closing is actually day 0 of 2 time clocks that IRS gives the client to accomplish their exchange. And I'm going to go backwards. The second time clock they get is called the exchange period, and they
Hmm.
get a total of 180 days to buy, close escrow, and be done. And the first clock is the first 45 days of that 180 are separated out to identify what they will be closing on.
Okay. So the property they're going to purchase, the next, they sell their property, close escrow. The next property they're going to purchase, they have, you said 180 days to close
Right,
escrow on their purchase. And then I heard you say 45 days to be able to identify possible
right,
properties. Okay,
right.
so what happens if I identify some properties in those 45 days and it doesn't I don't get those properties? Am I able to identify more before the 66 months is up and close on those, or?
Well, good question. So let me answer that in 2 parts. If something happens inside the 45 days that you know that you can't buy whatever was identified, you can change and update that sheet absolutely no problem. But once midnight of the 45th day has passed, whatever's on that sheet, it's basically etched in stone. And if you can't close on whatever's in that sheet, say we're in day 60, and you can't buy, close whatever's on that sheet, then the exchange will be disqualified. So it reverts back to a traditional sale, and the taxpayer will pay taxes. So that
Okay,
45 day is crucial.
yeah, that is a huge deal. That's a huge deal. And that's a very short amount of time to, be able to get your offer accepted or to find a property that suits your needs. Um, okay. And then so what is your role as the exchange accommodator in this?
My role is I help the taxpayer understand, like I do all the upfront educating and helping answer all the questions and help the taxpayer understand how to proceed with this path that they've chosen. Once the exchange is actually opened, I have a team internally in the company that will handle the actual paperwork processing part of that. So
Mhm.
now the taxpayer gets more than me. They get a whole team that works
Mhm.
in the behalf.
Okay, I see. And so in your career, there's been some exchange situations that have had challenges. What would you say is the major challenge for a prospective investor that is trying to accomplish a tender exchange? What's the main challenge you've seen?
The biggest challenge is that 45 days, managing that time properly. And I recommend everybody I talk to, I don't tell them what to do, but I give them recommendations based on what I've seen. And if it's humanly possible, start early. Like I said, back in the listing process, have that client narrow down exactly what type of property they're looking for, what they want, what they think they need. Then when escrow actually opens, they accept an offer, use that escrow period if it's possible, and maybe even you can negotiate a longer escrow period instead of 30 days, maybe 45, or
Okay,
maybe 45 to 60, because that escrow period is a valuable time looking for the replacement property, maybe getting an offer accepted, getting inspections done before the clock starts ticking.
I see. So I heard you say look at replacement properties um, and what you're going to move your equity into ahead of time. I heard you say maybe have an extended escrow period so that gives you more time to find a replacement property.
Mm-hmm.
Okay.
Yes. And
Okay.
I'm not saying they have to do that, but it could be a very valuable tool if they can get a few more days.
Hmm. All right. And then success stories. I mean, what those 1031s that have been successful, what have been the common feature characteristics, or what did they do to make sure that they had success?
I have had some of the most amazing clients that I worked with amazing success stories. They've utilized the 1031 ways in ways that have benefited them so beautifully. It's helped them grow their wealth. So one example is I had a gentleman come to me early in the 2000s, early 2000s, and he, through the years in the 70s, he bought his first investment property, and then he held that, exchanged that a few years later and bought two, and then through the years he kept doing that process. So when I met him in 2001, he had 60 properties that he owned by selling and exchanging, like instead of one for one, maybe 1 to 2 or 1 to 3. And
Hmm.
and then his biggest problem now was his retirement, because he started a property management business, just managing his own
Hmm.
properties. So he had a strategy that this would be his retirement, and it was his retirement fund. And he was able to, in the end, exchange out. And we're going to talk about it in a few minutes. He went into some DSTs.
Okay. And then what was what did he was obviously very successful. Um, what differentiates him from the 1031 exchanges that have gone wrong? Why was he able?
He was proactive. He didn't, he was, is, he used his escrow period, got a little bit longer period of escrow if he could. He found properties that worked for him. It was about numbers, not about perfect, the property sometimes people get caught up in, the kitchen isn't perfect or this. He was all about numbers and making sure that it was right for his budget and that he could get good rentals for this property, for the location. His strategy was amazing.
Okay,
And
I see. And then his first property, where was that at? And then where was his next properties along the way, if you remember?
first property was Huntington Beach, and he had to end up 60 houses in Huntington Beach.
Oh, he stayed in Huntington Beach.
Yes.
Okay.
And
All
that
right.
was, and I think that's another thing of his success. He knew his market. He knew what he was buying into, and he knew what would really work for him and his family and for his budget and what would be good rentals. And he went with it, and it worked.
Okay. So he just stayed in one location, stayed
Yeah.
locally. And any other, if for someone out there who's thinking about doing a 1031 exchange, you've already given the advice of identify potential replacement properties, be proactive in the escrow period, make your escrow period a little bit longer to give you the time, look at the numbers. That's what I've heard you say. Any other things that you would advise someone who's about to consider the exchange process?
Yes, in the exchange process, we haven't talked about this, is that what IRS requires is that you basically buy equal or greater to what you sell for, not what your gain is. Some people think that you're going to buy what your gain is. That's not the case. If you sell for $1 million, you're going to buy basically for $1 million. And I say basically because IRS lets you deduct the cost of sale, like commission, escrow, title, those one-time fees. So you can deduct that and go down the cost of those fees. But what's important to understand is that buying equal or greater, if they had a loan in there, then the only way they can buy is say they sold for $1 million, but they had a $200,000 loan. The only way they can buy for $1 million is they need to use the cash as their down payment, basically, an example, 800, and get a new loan to replace the loan that was paid off on the sale. So that's real important for the client or our taxpayers to understand, is loan debt needs to be replaced with a new loan, or it could be replaced with new cash. If they had money, like if I sold and I had a $200,000 loan and I had 200 in my bank, I could bring my 200,000 and use it for my purchase, and that would replace the loan debt.
So I have to qualify for the new loan,
Yes.
and be aware of that new loan payment, or
Yes.
have the cash to pay the new loan, and not have
Yes.
the
And I think
difference.
the biggest advice that I have is the loan debt doesn't disappear. If there's loan debt, it needs to be replaced one way or the other.
Mhm. Okay. And then in terms of investors in Southern California that have 1 to 4 units, what trends are you seeing in terms of on the upleg? What type of upleg, or are you seeing of investors here in Southern California?
It varies because everybody has different circumstances and different goals. But what I see is someone selling a larger asset, like a higher value property, and buying a whole bunch of smaller single families and going that route. Like I had a gentleman that sold land in Sacramento, farmland, $18 million. He turned that and bought a ton of single family investment properties. And then other people are selling a single family going to fourplex or triplex.
Okay. And then let's just say someone who's a tired landlord who's owned their property for a long time. They don't want to, take care of all those units or manage property. That type of perspective person.
So
What?
I'm sorry, Liz. The DST has a place in my opinion, definitely has a place in the 1031 world because it can do a few things. You have can I go through the scenario real quick?
Sure, yeah.
You may have a taxpayer that's older and has been managing their properties for 30 years and they're done. But if they sold this investment property, their taxes are going to kill them. And they're not going to have much gain left over. So a DST is beautiful in that regard if they do their homework and find a good property, because it's going to be professionally managed and they basically just get a check in the mail.
So what is a DST? What is that?
Thank you. It's called the Delaware Statutory Trust. And it's a type of investment where a taxpayer will buy a fractional percent of a larger industrial type of property or apartment complexes, some larger property that they could never afford to buy on their own. And they can buy a fractional percent of that property. And it's set up, this DST is set up in a way where it qualifies with the 1031. It works
Okay.
well with the 1031.
So if let's just say I sell, in that scenario that we said earlier, I sell my units, then I'm gonna buy a fraction of a commercial property or another, multiple unit property, and I have a fraction, right?
You get fractional percent interest, and then that provides rental income for you that you may get a check in the mail each month or maybe quarterly, whatever the arrangement may be. And
Okay,
you get
so
depreciation, you get appreciation, and you get to depreciate on your, fractional percent. You get the appreciation on it. You get to depreciate that percentage, and so it works exactly like a traditional investment property. It's just a different way. It's just a different type of property that's out there.
okay, so I once again I sell this property here, this 2 or 3 unit property, 4 units. I join this DST and own a fractional percentage. And you're saying an advantage is that I'll get some monthly rental income from that.
Right?
I can depreciate on my
Right?
taxes still. Any other reasons for
Yes.
investing?
So,
Yes.
so we talked about maybe the investor that's older and they're tired and they want a way out. Other people are buying something and they're buying a little less in value and they have money left over that we call boot or tax, which is a taxable event. And maybe they're $300,000 short. That 300,000 could be used to buy a small percentage of a DST. So now they
Ah,
have a standalone and they have a DST and they covered all their taxable event. And the third thing that gives the next benefit is the 45 days. You can get into a DST pretty quick. So, you work with the ones that represent these type of properties, and you can get in there, find your property, get it taken care of definitely inside the 45 days. So it could be a nice backup to, you may have a traditional standalone property and then maybe DST as a backup just in case something goes wrong.
okay. So I sell my property, let's just say for $1 million. I buy one for 600,000, and then I have $400,000 difference, or I can put the $400,000 into a DST and still get the capital gains tax deferment rent.
Absolutely. And you got
And I don't have to manage it. I don't have to.
exactly. And you diversified. So you have two different types of properties and it's working for you.
Okay. And in people who are doing that you're seeing in Southern California, investors in Southern California who are retired landlords, where are you seeing them reinvest their equity?
There are properties all over the US, maybe in a college town, they may be dorms, they may be medical use, they may be huge apartment complexes. So the sponsor that owns the property will work with the investor. They'll do their due diligence. They can read property prospectus in regards to what makes this property beneficial. Is it a federal building where the town, that's the major employment for the town? So, a federal building may be a great investment if that's like the major employer of the town. So there's a lot of little things that need to be looked at, but it can be a marvelous tool. Like I said, the properties are in California, all over the US, and the sponsor that works with the client and that owns these properties would help them find one that fits their criteria.
Okay, and then what will be the major challenge with or disadvantage of moving my equity into a DST?
I think a DST, in my opinion, the biggest disadvantage is it's not an asset that you can sell on your own when you want to sell it. So what happens is the sponsor that owns that property will have like a scheduled have a schedule of how long they want to hold this property to get the right appreciation. And so it could be held for 5 years, 6 years, 7 years. They pretty much tell you for each property you're looking at what the schedule may be. So you don't have the ability to, like, maybe something's going wrong in your life and you just want to sell the property and cash out at that time. You don't have that choice because you don't own that individually. You own a fractional percentage.
Okay, so you don't have the option of just selling your fractional percentage.
Exactly.
Okay, so you're waiting for the decision maker of the DST to sell the entire complex.
Yes. And then when that
Okay.
happens, you have the choice of going into another DST or going back to traditional standalone real estate. So whatever
Okay.
you want to do.
So then when they decide to sell, you have to do another 1031 exchange
Yes, on your
for your
percentage.
100%. Okay. All right. Thank you. Thank you for the, you answered my questions. I feel like I got something here. Hopefully the audience learns. I'll definitely send this to anyone considering doing a 1031 exchange. If someone has 1031 exchange questions, Debbie, what's the best, you want to give your website or how they can get a hold of your email and information?
Absolutely. So our company's name is Exchange Resources Inc. And our website is exchangeresources.net. And my personally, they're welcome to call me personally, email me personally. It's my
Mhm.
pleasure to answer and help assist with any questions. So they can call me or text me at 714-269-1285. Again, 714-269-1285. Or they can email me at my company. And my email address is my first initial and last name. So it's Bannister, BANNISTER, at exchangeresources.net.
Okay. And can they sign up for your wonderful e-newsletter?
Absolutely.
All right. Thank you for being here.
Absolutely.
Appreciate your time.
Thank you for having me. I appreciate doing this with you. Thank you.